This is with regard to your homework 3, where you have to create a basis chart. And so I go to the usual bar chart page, and you see crude oil, WTI, and then you go here and you see crude oil, and this is cash or spot, and this is crude oil nearby contract May 17. So I need to get the quotes for them. So crude oil, when I do crude oil cash, you see it says here CLY00. So note that down. And then when I go to back to the page, and then I see here crude oil WTI, and then again it's a index is CLK17. So again, remember those, note that down, and then go to the chart page. And basis is known as spot minus futures. So in that, there we go to the spread, and we say in the expression bar here CLY00, which is the spot, minus CLK17, and then we draw, and then after that we get a basis chart. So you can see a basis chart, and you can see the trend, and if you want to be more precise, you go to this, and then you take this bar and take it to the top, which is going to be saying that, well, your basis is steeply upward sloping. Now, as usual, you do the indicators. Here, all the indicators have to be added to this. So, well, first thing is the fast stochastic. And when you do the fast stochastic, it's here, you draw it, and then you do the slow stochastic. Again, you go there, and then do the slow stochastic and draw it, and then you go to the next one, which is ADX, and then you do the last one, which is going to be RSI. So that's RSI. So this is that, and then you get your basis chart, which is the homework that you have to do. Now, in order to interpret this chart, you have to go to the module section and find this file, which is known as normal backwardation on contango in futures market, all 8 cases. So there are 8 cases here, only that first one and the last one are the ones that where you do not hedge. So now that you already identify the market, you know how to identify the market, and that is known as necessary condition. So suppose you identify the market as backwardation, and then after that you do the basis analysis, which is a sufficient condition. In basis analysis, which is spot minus futures, is here -1, spot minus futures in -8. So you see that it is significantly downward sloping. So in that event, you know that you cannot hedge, because if you hedge, you lose -12. So what is the flip side of it? If you do not do the hedging, then of course you can say that, well, this is another fundamental analysis whereby you can find out that, well, long side is going to give you 12. So you take an investment decision of long 12. So now, if you take that investment decision, you now have long spot and long futures. This is facetiously known as Texas hedge, which is like you are extremely bullish on that asset. So that is the way you interpret basis analysis. That is, you do not hedge if it is in a normal backwardation market, if it is steeply declining. And then other part is that the number 8 case, where you have a contango market identified and basis is steeply rising. In that case, you do not hedge. Now go back to the chart here. Let's say this is upward sloping, and then you also identified this market as contango. Assume that. Okay, so you go back to this chart, which is this chart here, number 8, So you identified this to be as contango and basis is rising. So in that case, you do not hedge, and hedging is the long futures. So what do you say? You say that you have to go do the short futures. So you invest in short. So now you have a short spot and short futures. So that is the part. And then you see, basis analysis is so much important. And this importance can be understood when you go to the classic case that we always show. And this is the case where a company in Germany, which is a public-private company, Metal Gesellschaft. Metal Gesellschaft, well, in short, is MG. If you know German, you can pronounce it better. And what the setting is that they are going to supply the oil to their customers. And so what do they do in order to sell this oil? They're short. That means they are guaranteed a price. However, they did something else, and that caused them $1.8 billion loss. And what happened was MG promised to give the customers the oil, so they took a short position, guaranteeing them a specified price. It's a $160 billion worth. And then they go to next level in their risk management department, identified the market to be normal backwardation. So in a normal backwardation market, what do? You say that, well, we expect the price to rise. So if you expect the price to rise, what kind of positions will you take in futures market? Obviously long position. And mind it, they have a short position in forward market, and forward market is a long-term market. And they, in addition to that, they took a short position in the forward market, futures market. So first there's a gap. One is the long-term, and other is the short-term. Second thing is this: they have in forward market there is no margin requirement, so nothing transpires until the time of delivery. And in futures market, every day you can see your loss or gain. So that way there is a mismatch. So the mismatch about the term and mismatch about the nature of the contract. So what happened was, instead of price rising, it fell about 20%. And so they had a short forward contract which increased in value when their price dropped, and they have a long future contract which decreased in value because the price dropped. So now this part, because of the margin requirement and transparency, everything was coming to the public that they are losing millions of dollars. So at some point when they reached they lost $1.8 billion, they pulled the plug. So this is the classic case where we say that, well, if you do not do the basis analysis, you are in a deep problem. So going back to this chart again, that you must do basis analysis. So you should be able to interpret that. So in a bar chart, you got this chart, and you have to present it to me, and then you have to give the interpretation with regard to this part. So now that is that. And then there is another thing that you have to do on bar chart. You see here, you have to give me an option. So if you go to options, click on options, then you get the crude oil WTI American options, and then you have to tell me what it means, and especially the delta. You see 13.97 for a strike of 34. So you multiply by this 1,000, which is the contract size, 1,000 barrel, which is 13,970. And if you take, let's say, $40 here, and you see this 8.01 cent multiplied by 1,000, 80.10, and delta means it's a change in call price with respect to change in underlying asset. So if the asset goes up, oil price goes up by $1, call premium will go up by 0.97. So if you have any question, let me know, and thank you.